Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch. I'm joined here by we're missing someone, and we'll address that here in just a second, but I'm still joined by my colleague on our advanced planning team, Jacob Messick.
Troy, I'm digging the attire today. I'm glad you joined into the summertime attire.
This is this is my ode to the summer. Like I feel like I should be sitting somewhere on a veranda. Yes, I'm using the word veranda. I'm not putting anything in the jargon jar.
I don't know what that means.
Well, call it a deck.
All right.
I'm sitting out on the deck, and the wind's sort of wafting in what used to be my hair, and I have I had the hat on. I'm sipping a cafe au lait, except I don't like caffeine. I've never drank caffeine, so we'll just call it a Fresca.
Okay.
I'm drinking a Fresca, and the wind's blowing. It's summertime, and we're still doing Future Focus.
Summertime's a little bit more fun. I got to say, walking around the office here today, you get a lot more smiles and laughs as people see us wearing the Hawaiian shirts and you with the nice fedora.
Believe it or not, I've gotten no less than 5. I really like the hat. I'm like, I think I should wear this more often.
Yeah.
People they compliment this hat all the time. So we'll see how long I stay in it, because believe it or not, this thing is hot. So
they know it's podcast day.
Yeah, it's definitely podcast day. So,
all right.
So what are we going to do today? Clearly, we're missing someone. Keely Joe isn't here. That's her. She decided to go on vacation, free time, work-life balance, all that other good stuff. But what are we going to do today? It's just going to be you and I. And we're going to go to the bullpen.
Yeah.
We're going to go to the bullpen. You won't see her, but you will hear. It'll be this voice, this disembodied voice that are going to ask the questions today. So I get to actually participate and answer questions more than I normally do.
I like it. They're probably thinking, what did we get roped into? But I like it for today.
Exactly. So what you're going to hear today is you're going to hear our intrepid producer who's been like day one, with us, and was like, hey, we got this idea. And she didn't look at us and go, you guys are nuts. Plus, she probably did go, you guys are nuts. But she also said, I think that sounds like a good idea. You're going to hear the voice of Cassie, our intrepid producer, who's going to ask us our questions. Today, we're going to harken back to something that we did last year, and that's myth or reality. Cassie's going to ask us a question, myth or reality. We're going to answer the question whether we think it's a myth, whether we think it's a reality, and hopefully we have a great discussion. In this case, we're going to talk about life insurance. Don't turn away. We're going to talk about life insurance, and we're going to talk about ownership. This is going to be a two-parter. We're going to talk about ownership, and we're going to talk about beneficiary choices, if you will, or designations. That beneficiary designations is the technical term, but we're going to talk about beneficiary choices in part 2 of our myth or reality conversation. How's that?
I like it. It's two types of questions we get all the time, and as people are going to see, setting things up. There's ways to set things up and set things up properly. So hopefully we can provide some education.
Absolutely. And speaking of education, we'll just go ahead and what we always do at this point. Everything we talk about is general education. It's not intended to be a specific recommendation. So just go ahead and keep that in mind as we walk through this. Also, I'm going to tell everyone it'll probably be my task, my job, my hope is that we can actually get Cassie to laugh, to actually laugh while she's actually on the mic.
That's right. She's mic'd up. We usually hear some laughs in the background, but now with the mic there, we can definitely capture some of those live.
So we'll see what we get.
Yeah.
All right.
I like
Ready?
it. Yep.
Okay.
Cassie, here we go.
We're ready to start.
Yeah.
Okay. Myth or reality number 1. It doesn't matter if the owner, insured, and beneficiary are all different people on a personally owned life insurance policy.
You go first?
Well, I usually go first. And first off, Cassie, great job reading the question. I knew we made the right choice, but I usually go first. You go first.
So are we just going to go myth, or myth, or myth reality, or whatever, and then we'll get into it?
Yep.
Okay.
Yep.
All right. So for that question, Cassie, would you read that again for me, please?
Oh, it's not so easy answering the questions.
It doesn't matter if the owner, insured, and beneficiary are all different people on a personally owned life insurance policy.
That I'm going to say is a myth.
I'll agree with you. I'm going to go myth as well. I mean, while yes, they can be different people, there's some unintended consequences that could result because of that. So myth, and then we'll dive into it.
Myth, and we'll dive into it. And I might as well just go ahead and throw this right now, because I'm going to say something. The reason why it's a myth, and yes, you could do it, but why you shouldn't do it is something called the Goodman triangle. So it's already in there. I'm going to describe it, but I just know I wasn't going to get. I can literally hear Keely Joe like going no. So okay. So what is the Goodman triangle? And Goodman is the name of a court case. That's why it's and that's why it's named the Goodman triangle. The basis behind the Goodman triangle was that if there are three parties to a life insurance, there are three parties to a life insurance policy. There is the owner, there is the insured, and there is the beneficiary.
And I guess before that, let's kind of break that down. So obvious owner, that's the person that controls the policy. The insured, that's the person whose policy that life is on. And then the beneficiary is the person that receives the death benefit in the event that the insured passes away. So owner, insured, beneficiary.
So if those three parties are different and the insured passes away, it is seen as a gift from the owner to the beneficiary. So and sort of basic rules, all things being equal, life insurance death benefits pass to the beneficiary free of income tax, right? Again, this is general education, but life insurance death benefit in general passes to the beneficiary free of income tax. It's one of the reasons why people love life insurance, right? But if the owner, the insured, and the beneficiary are different people, so oftentimes the owner is the insured, or the owner, may be the beneficiary, with the insured being someone different, right? Like, so if the owner, the insured, and the beneficiary are different people, it is considered a gift when the insured passes. It is considered a gift from the owner to the beneficiary.
Yeah. So in that scenario, what that does is that exposes that death benefit to gift tax liability. And, for a lot of people, if you have a taxable estate less than the lifetime exemption amount, $15 million per person, it might not be that big of an issue. But where it becomes an issue is if you are a high net worth individual, you have a taxable estate above the lifetime exemption amount, or even if you are in one of the states that have a state estate or inheritance tax, one of those 17 states. A lot of those go a lot lower, down around $1 million is as low as some of those may go. That's the situation that now you're exposing that death benefit to some unintended gift tax exposure. So that way, if you were planning to give those heirs, let's say, $1 million death benefit as policy, it might not be the full million if a portion of that is subject to gift tax and estate tax.
Fun fact, who pays the gift tax?
Is it? I wasn't ready for this one. You went off the roadmap.
Where's Keely Joe? It should be all over it.
It's
what people don't realize is that the owner or the grantor, the person giving the gift, that's who pays the gift tax. That's who's responsible for the gift tax.
I can't believe you put me on the spot like that. Game on. It's all gloves are off.
What are you talking about?
But no, so let's make this like a real situation. I mean, this is the one we see a lot. Husband owns a policy on a spouse, and they name their adult child the beneficiary.
Right.
Spouse passes away, then the beneficiary, that adult child, is getting the death benefit. And that's considered a taxable gift from the surviving parent who's the owner. That's one of those situations that we see. But like you said, so a way around that, a way to fix that issue is two of the three parties have to be the same. Typically, it's the owner and the insured is the same individual, or the owner and the beneficiary is the same.
That's what we usually see.
Yep. And so as long as two of the three, you're not running into that issue.
Absolutely.
Yep.
Okay, ready for number 2?
right? There's no roadmaps. Now we got someone telling us.
I know. And
telling us that
I'm used to making the transition and go, okay, I guess we're ready.
now it's like transition time's here. We're moving on.
Okay.
Got it.
Yes,
Question
we're
number
ready for number two.
Okay. Myth or reality? If the owner and insured are already different, naming a successor owner is optional.
I'll go first. Optional. I'm going to go myth.
Oh, if the owner or insured is already different, naming a successor owner is optional. That one's
It's worded tricky because while yes, maybe this is what you're thinking of. Yes, you don't. I mean, technically,
optional.
You don't need to name a successor owner, but is that the best practice? The best practice answer is no, and because of that, that's why I'm going myth that you should have a successor owner.
So I'm going to go reality because it is optional. Probably not best practice.
All right. I like that.
I gotta break out the law school a little bit. Right?
No, I like that. I mean, it is. I think the reality, but best practice not. I'll give you that answer.
All right. Do you want to do why the successor owner is important?
Yeah, I think because a lot of people, so we kind of talked about the last time, that husband and wife situation. Husband owns the policy on the wife. And we talked about the first scenario, the insured passed away first. Well, second scenario, let's say that owner passes away first. They're not the insured. A lot of people might think, oh, owner passed away. Ownership is automatically going to go to the insured. Well, that's not the case. Where it doesn't automatically go to insured. If there's no successor owner listed on the policy, it is going to go into that deceased owner's estate, and now it becomes subject to the word that we talk a lot about, probate. Yeah. And you want me to talk about probate?
Probate is I know we've talked about it quite a bit, but we talk about probate as something to avoid. What is probate? Probate is the system that is put in place when you are transferring things, specifically by a will. Probate is the sort of the order of operation and the system that you go through to hand out, to transfer property. And again, typically that's by will. Has a reputation of being a process that if we can avoid probate by giving things away, clearly giving things away through trust or beneficiary designation, which is why we don't want to take an asset like life insurance and end up gumming up the system that it could be given away by a beneficiary designation. So probate is that system of giving property away, it's where the instructions that you have, specifically in a will, allows you to sort of give property away. And if you don't have a will, probate is still a system where your stuff is given away. It's just a state.
Feel like there's a word that describes that, but I just can't recall that word off the top of my head. It's a legal term that I know you probably.
Go right ahead.
I can't. I don't know what it is.
I'm
drawing a blank.
Go ahead and say it.
I'm drawing a blank. It's not in my notes. You're gonna have to refresh my memory on what that legal term is for someone who for which the laws of a state reference how people inherit property.
How people inherit property. He's trying to get me to throw here's the game, right? The game is up. He's trying to get me to say something legal, and then I got to end up throwing the thing into the jargon.
All right, I'll
go right ahead.
I'll go ahead. That way we can keep it right. What is it? The state intestacy and laws.
That's a big word there.
Did I pronounce that right?
Intestacy?
Yeah. Did I say that right? So there we go. So that's what I'll throw. You win. I couldn't get you to say that, but no, like what you said. Probate, extra costs, extra delays. The policy might not go to the person you intended. So, there's just more efficient ways to make sure that if something happened to the owner first, the policy goes to the right individual. So what we see a lot, naming that successor owner, whether it's the insured themselves, whether it might be a trust. those are just a couple ways to consider to put that step in place to keep that effective transfer.
You see it, like I remember when my mom passed away, I remember that there wasn't a successor owner, and my mom's estate wasn't very big, at all. But still, there was a question like, what does the life insurance do? Now, fortunately, we had to use the life insurance for funeral costs and things like that. But when you're thinking about, if you're a parent out there and you're thinking about, I have a life insurance policy on that I owned. Like I purchased the life insurance when my child was a minor.
Yeah.
Right. You should be thinking about, do I need to make sure that if something happens to me, if things fall in the natural order of succession, I'm going to pass away parent before my child. I want to make sure that the successor owner, if you're not going to transfer while you're still alive, make sure that that child is named the successor owner on the policy that they're the insured.
No, that's a good one. I mean, we talk spouses, but yes, a parent owning the policy on their child.
Spouses is another good one.
Is a very common, from a business planning, cross purchase, buy sell is a scenario we see. But so all of those are different scenarios where these are situations that this comes up on. And so, typically on the application, when people are going to fill it out, there's a spot to reference a successor owner.
Right.
That's why that's an important field to remember and why it's there.
Absolutely.
Yep.
I think we're ready for number 3.
I think
Yeah.
we're
Again, I'm used to transitioning through it.
Okay, I was waiting for your cue since
Okay,
I jumped
all right.
the gun the first time.
Hey, far be it from me.
we'll get these cues down.
Okay, myth or reality? Ownership could result in the life insurance policy being subject to estate taxes.
Oh boy, I see that is reality.
I'm going to go reality as well.
Should we just go ahead and get it out right now? Why ownership, what it takes to not have it be included in estates?
Yeah,
Or
we could always
just
rock, paper, scissors, arm wrestle or something to see who has to throw it in. But if you're offering,
No, I'm not.
I'm not going to stop you.
I'm not necessarily offering. I just, So the idea of why this is a reality is it's all about ownership and ownership at the time of death as it relates to the estate tax and whether or not it's included in someone's estate. There's this thing called incidents of ownership. I was going to look up the exact code section. I think it's 2036, but don't hold that against me if it's not. It's one of those 20 numbers. It's like 36 or 38 or something like that. There's about 5 or 6 code sections.
Look at me. I'm not the one with the law background.
There's like 5 or 6 code sections that all center around like sort of life insurance and ownership and what that means. Basically, if I own it at death, if I have incidents of ownership, things like I can name the beneficiary, I control the policy, and those things aren't exhaustive. But if I
wrote down what those things were just so we can provide a little bit. So typically the 5 things you see: change in beneficiary.
If you can change the beneficiary, you own it.
Borrowing against the permanent life insurance policy.
If you can go take a loan, you own it.
Pledging the policy as collateral.
If you can, make it something that someone else, would find valuable to acquire a loan or dollars or whatever it may be, you own it.
Assigning or transferring ownership.
If I can give the ownership away, then you clearly owned it.
And canceling the policy.
And if I can say I don't want to own it anymore, then you owned it beforehand.
All those things are what's considered. If you have those things, any of those things, you have control of the policy, you have that incidence of ownership.
So no matter what you do, if you retain incidence of ownership or you have incidence of ownership, that's included in someone's estate. So whether you owned it or not is determined by this idea of incidence of ownership. And if you do have one of those, then you're considered to have own the policy, and in this case, at your death, and that's included in your estate, which can affect estate tax or state estate tax, whatever it may be.
And so we talked about, hey, the lifetime exemption amount, the federal lifetime exemption amount is $15 million per person. But if you say, let's say you have, $10 million of taxable assets, but you have a $10 million life policy that you own, that's inside your state, that's going to bump you above that lifetime exemption amount. Now you have estate and gift tax to be aware of, as well as if you're in a state that has that as well too. So that's where, while owning a personal policy, that's just something to be aware of. But there's ways that you can get the policy outside of your estate. If you're concerned about estate and gift tax, hey, you can do something to then have the policy owned outside of your state.
Right. And you can do that either through like the way you set it up initially. With life insurance, there's sort of special consideration of, hey, I got this now someone goes, I got this life insurance policy that I don't want in my estate. Like, what do I do? With life insurance, there is a consideration of even when I give it away to get it out of my estate, I still have to, there's what's called a 3-year look back, that if you give the life insurance policy away, and when I say give it away to a trust or some other entity or someone else, there's still the law will look back 3 years from that transfer and say, "Ooh, you passed away," but it was within 3 years. They'll pull that death benefit back into that estate. If it's outside of 3 years, you don't own it anymore, and just like what Jacob talked about, it's now outside of your estate.
Yeah. So that's typically the conversation that we have. Hey, if an individual is concerned about estate taxes, then the life insurance policy, that might be something that they consider having it owned by a irrevocable life insurance trust to be outside their estate.
And I think you mentioned this, but also not just because I always wonder, like, I always not worry, but I wonder, like, 15 million, it's not a big deal. But you think about if you're, like you mentioned, those 17 states that have a state estate tax. There's some states that you're subject to a state estate tax and an inheritance tax. So just there are reasons less than $15 million reasons to still think about not having the life insurance in your estate, and obviously not having incidents of ownership.
And we've said this before. That's why things need to be reviewed on a regular basis. It's talking with a financial professional, because while you might not have an issue now, hey, if you own appreciating assets, you might have that as a situation now, but maybe it's a situation in 5 or 10 years. And we know that the lifetime exemption amount is always changing. And so it just makes it as a reason of why just reviewing on a regular basis is something that's important to consider.
Yep. Review.
Yep.
All right.
I
think that's our ownership.
Cassie, I think you did an excellent job reading us the questions. I think we're going to have to continue this when it's just situations like it's you and I here. Yeah. But no, I think questions are done, and think it's back to you for transitions.
Back to me for transitions. All right. So make sure you like and subscribe, and I'm going to continue to sort of preview. We have something special coming up. I don't want to sort of pin anyone down right now, but definitely I want to preview that we're going to have something special as it relates to Future Focus, and how you're going to be able to. I'll just give you a little bit more. How you're going to be able to view or listen to Future Focus in the future. All right. I'll just leave that little. That little tease out there. Maybe we call that a tease in the business.
Maybe listen to us in the car while you're driving a little bit easier,
and not be a road hazard because you're looking at video,
or walking through the neighborhood and actually looking up so you can as you're crossing neighborhoods. So
we'll just leave that as a tease.
I like it.
So make sure you hit like and subscribe. Below. We always love your comments. Remember, every 5th episode we do a listener episode, and we actually have a fun listener episode coming up in episode 30. So we really, really value your comments. We really, really value your questions, and we want to cover ideas and concepts that you want to know about. Stay tuned for our next episode of Myth or Reality, where we get into life insurance beneficiary questions. Okay, so I want to thank everyone for your time and attention. Again, please make sure you like and subscribe down below, and we look forward to seeing you on the next episode of Future Focus. I'm Troy Branch. You guys have a great rest of your day.